Imagine you have $600 in your hand right now. You're standing at a crossroads in the precious metals market. One path leads you to a heavy stack of 12 pure silver bullion bars, tangible, shiny, and universally recognized wealth. The other path leads to a single, small, weathered coin, the 1866 Mexican peso. One person walks away with a pile of silver. The other walks away with a tiny piece of history. Who made the smarter move? Who will survive a sudden market collapse? Most people think the answer is obvious. Buy the most silver for the least money, right? But in the world of high-stakes investing, what seems like a rare opportunity can often be a perfectly disguised liquidity trap. Welcome back. Today, we're breaking down a critical warning issued by veteran dealers that could save you thousands of dollars. We're diving into the liquidity paradox, why that $600 coin you're holding might actually be worth nothing but its weight in silver when you need cash the most. If you've ever been tempted by a rare coin over the phone, or wondered if your collection is a gold mine or just a pile of overpriced metal, pay close attention. We aren't just talking about silver today. We're talking about the difference between holding an asset and being stuck with a liability. Let's look at the cold, hard numbers. To understand why dealers are issuing this silver warning, we need to put these two assets on a financial scale instead of a historical one. Let's strip away the romance of the 19th century and look at the cold, hard math. First, let's look at our contender, the Maximilian peso. It's beautiful, it's rare, and it's historical. But from a raw material perspective, it contains roughly 0.78 troy ounces of silver. At current market rates, the melt value, the actual silver inside, is only worth about $50. Yet, as we saw, these are trading for $600. Now, let's look at the alternative. If you take that same $600 to a bullion dealer today, you aren't walking away with one coin. You're walking away with a stack of 12, maybe even 15 one-ounce silver buffalo rounds or Britannias, depending on the spot price. Do you see the gap? That is a 1,200% markup over the silver value. In the industry, we call this the premium. Now, premium isn't a dirty word. Every coin has one. When you buy a standard silver eagle, you pay a small premium for the minting and the trust. But when you buy numismatics, collectible coins, you are paying a numismatic premium. You aren't just buying metal, you're buying a story, a mintage figure, and a grade. You're betting that in 10 years, someone else will want that story more than you do. But here's where the math gets brutal. For your $600 Maximilian peso to double in value, the story has to become $1,200. For your $600 of silver bullion to double, silver just has to go up. Think about it. If you buy the bullion, you own nearly a pound of silver. If silver goes to $50 an ounce, your 12 ounces are worth $600 in raw melt value alone. You have a massive safety net of physical commodity. With the collectible coin, your safety net is tiny. If the collector market cools down, if people stop caring about 1860s Mexican history, your $600 investment is still anchored to just $50 worth of metal. You're floating $550 above the ground with no parachute. This brings us to the dealer's secret. Dealers love selling numismatics because the margins are huge. But the warning they're giving now is about the distinction between an investment and a hobby. When a dealer over the phone tells you a modern, shiny coin is rare and charges you 300% over spot, they're not helping you stack wealth. They're selling you an expensive hobby under the guise of an investment. The logic is simple. Bullion is a play on the metal. Numismatics is a play on scarcity. And as any veteran investor will tell you, scarcity is subjective, but an ounce of silver is always an ounce of silver. So if the math is so heavily weighted towards the bullion bars, why does anyone ever buy the coin? Is it just for the art? Not quite.
There is a hidden mechanism that allows these rare coins to outperform silver even when the market is crashing. But to find it, we have to look at the one thing most investors overlook, the liquidity trap. And that's where things get dangerous. But math is only half the story. There is a silent killer in the world of investing that most people don't see coming until it's too late. It's called the liquidity trap, and it lives inside the spread. Let's define that simply. The spread is the gap between the price you pay to buy an asset and the price a dealer will pay to buy it back from you immediately. If you buy those 12 bars of silver bullion we talked about, the spread is incredibly thin. You might buy them for $10 and sell them back for $9. That's a 10% friction cost. It's efficient, it's liquid, it's essentially cash in a different form. Now, let's look at our $600 Mexican peso. The spread here isn't a crack, it's a canyon. You buy it for $600, but if you walk back into that same shop an hour later needing emergency cash, the dealer might only offer you $350 or $400. Why? Because they have to find a very specific person, a collector, to sell it to. They might be sitting on that coin for 6 months before they see a profit. That 30 to 50% loss the moment you leave the shop, that is the price of entry into the numismatic world. Now, imagine a crisis scenario. The stock market tanks. People are panicking. They need rent money, grocery money, gas money. In this environment, everyone is a seller and nobody is a buyer. If you have your 12 bars of silver, you can walk into any coin shop, any pawn shop, or even sell to a neighbor. It's a raw commodity. People know what it is. You get your cash and you move on. But who is buying a $600 historical artifact during a recession? The pool of buyers for high-end collectibles shrinks to almost zero during a financial storm. This is the difference between paper value and pocket value. On your balance sheet, you might be worth $600 with that coin, but if you can't find a buyer, the only thing you actually have is $50 worth of silver and a very expensive lesson in history. This is exactly what the dealers mean by a silver warning. They see people dumping their life savings into rare coins, thinking they are building a liquid safety net. They aren't. They are building a museum. A museum is beautiful, but you can't spend the paintings at the grocery store. You have to ask yourself, are you investing for total wealth or are you investing for total control? If you are just starting out, being stuck in a high-spread, low-liquidity asset is the fastest way to lose your momentum. You become house poor, but with coins. You have the assets, but you have no freedom. But wait, if the spreads are so high and the risks are so great, why do the world's wealthiest investors, the 1%, still pour millions into rare coins, fine art, and vintage cars? Why would an intelligent billionaire choose a high-risk collectible over a safe stack of bullion? The answer isn't what you think. It's not about the art, and it's certainly not about the silver content. It's about a secret strategy called diversification within diversification. There is a way to make the spread work for you instead of against you. But to do that, you have to stop thinking like a stacker and start thinking like a portfolio architect. So, how do the pros play this game without getting trapped? They don't just choose between quantity and quality, they master the balance of both. To build a bulletproof portfolio, you need to know which hat you're wearing, the stacker or the collector.
First, let's talk about the stacker. If your goal is protecting your purchasing power and building an insurance policy against inflation, you are a stacker. You care about quantity. You want the most ounces of silver for the fewest dollars possible. For you, silver is a commodity, a raw material of survival. You aren't looking for a $600 peso, you're looking for that stack of 12 bullion bars. Your win isn't a price spike in a collector's catalog. Your win is the peace of mind that comes from owning physical weight. Then there's the collector. This is for the investor looking for explosive returns driven by scarcity, history, and demand. You aren't buying metal, you're buying a non-correlated asset. When silver prices go sideways, a rare Maximilian peso can still skyrocket because there simply aren't enough of them to go around. You are playing a game of skill and deep research. But here is the golden rule, or should I say, the 80-20 silver rule. Most successful precious metal investors suggest a split. 80% of your holdings in physical bullion, your quantity base, and no more than 20% in high-end numismatics, your quality moonshot. This way, if the collector market hits a liquidity trap like we discussed, your foundation is still solid. You have the weight to carry you through the storm and the rare pieces to give you that extra edge when the sun shines. But there is one massive catch. In the world of quality, an uncertified coin is a gamble. This is where grading comes in. You've probably seen those coins encased in hard plastic holders or slabs. Why does a simple plastic box make a coin worth 5 times more? Because that slab isn't just plastic, it's a guarantee of authenticity and a definitive grade from experts like PCGS or NGC. In the numismatic world, the difference between an AU, almost uncirculated, and an MS, mint state, can be thousands of dollars. Without that grading, you're just taking a dealer's word for it. And as we've warned, words are cheap over a telephone line. A graded coin turns a subjective hobby into an objective asset. It provides the data, the population report, and the confidence needed to eventually sell that coin for its true value. So, before you spend that next $600, ask yourself, is my foundation built yet? Do I have enough weight in my vault to justify chasing the story? Because at the end of the day, you don't want to be the person with a house full of rare artifacts but no food on the table. You want a portfolio that is as liquid as it is lucrative. We've covered the numbers, the traps, and the strategy. But there's one final question you have to answer before you ever pick up the phone again to call a dealer. And the answer might change the way you look at your safe forever. At the end of the day, the choice between silver bullion and numismatics isn't just about what you're buying. It's about who you are as an investor. Silver bullion is a game of discipline and sheer volume. It's for the person who wants a rock-solid foundation, someone who values liquidity and knows that an ounce of silver will always be an ounce of silver no matter what happens to the world. On the other side, rare coins are a game of knowledge, history, and extreme patience. It can be incredibly lucrative, but only if you have the stomach for the high spreads and the wisdom to avoid the liquidity trap. The dealer's warning is clear. Don't let a slick sales pitch over the phone turn your hard-earned wealth into an illiquid hobby. If you haven't built your foundation of raw bullion yet, chasing high-premium rarities is like trying to build the penthouse of a skyscraper before you've even poured the concrete for the basement. So, here is my question for you today. If the financial markets were to shut down tomorrow morning and you had to rely solely on what is in your safe right now, would you rather be holding those 12 bars of pure, tradable silver? Or would you stake your future on that one rare $600 coin? Leave a comment below with your choice and tell me why. I'll be jumping into the conversation to reply to your thoughts. Before you go, if this breakdown changed the way you look at your next purchase, hit that like button and subscribe. Let's keep stacking smart, stacking safe, and most importantly, stacking with a plan. I'll see you in the next one.